gold bars at Costco, investing risk and balanced portfolios. This is Ken Boyd with the Accounting Accidentally Substack channel that you can find here. So you can buy gold coins and gold bars at Costco. And I'm frankly as surprised as you are. I go to big box stores to buy wool socks, mayonnaise, and bourbon in bulk, well, mostly bourbon. And I was really surprised to see that you can buy gold through Costco. So there's a quote from the Wall Street Journal. While he doesn't expect to routinely buy gold bars from a big box retailer, Williams is now among a vocal number of Costco fanatics and gold buyers who have flocked to the retailer's website over the past year when it periodically puts up limited quantities of gold for sale. Now, there are some restrictions. Costco limits the number of gold bars an individual can buy, and the gold usually sells out quickly, and people are big fans. In fact, there's Reddit message boards on this subject of people keeping track of when gold is available, how much did they pay for it, how does that compare to other sites. Now, investors who want to buy gold or have exposure to gold as an asset class, there's other ways you can do it, have plenty of options. In fact, you can buy gold exchange traded funds, for example. You can buy an ETF for the S&P 500 stock index. You can buy an ETF with gold. So the problem to me isn't access to gold. It's understanding investment risk and monitoring your entire portfolio. So if prices decline 20%, is that something you could live with? How do you assess your personal tolerance for investment risk? Too often people consider the joy of the upside, but not the tragedy of the investing downside. So a great question that I've used for years, a lot of investment advisors have. If your investment declined 20% in 1 year, is that something you could live with? You might decide that's more risk than you're willing to take. So maybe the question is, well, what about a 10% decline? Could you live with that? It's a useful exercise to assess risk. And once you have the answers, you, with the help of a financial advisor, can look for investments that fit your risk tolerance. Price fluctuations in gold. Gold prices have varied widely in recent years. If you're on Substack, you can click on a chart here that shows you just how much prices have varied. So check out these price swings. July 2012, 2173. 3 years later, July 15, 1413. It's a 35% decline. September 2020, the price recovers close to where it was in 2012. So as you can see, the price of gold declined 35% in 3 years, or over 10% a year. Fortunately, the price recovered slightly above the 2012 price by the time we got to September of 2020. So why is all this interest in gold investing? The psychology of buying gold. Fall of 2020 was during the really scary months of the pandemic. We didn't have a vaccine yet. There was a lot of fear. And so gold prices rebounded to the level of the 2012 price that you saw above. So why is that? This illustrates a feature of gold. Generally, when investors feel a sense of panic, uncertainty, they head for gold. The justification of many people is that gold is a commodity. It's something you can touch and feel. And there's a finite amount of gold in the world, which gives people some comfort that gold will always be worth something. So how much of your investment portfolio should be allocated to gold? Well, if you do some homework on the web, the consensus seems to be no more than 5 to 10% of your portfolio. So what's my concern? How much are these Costco buyers buying in gold as a percentage of their portfolio? Is it more than 10% of their portfolio? Is it 30%? So who knows? And if this idea of weird investing strategies, investment risk makes you uneasy, I have a solution. A better way, asset allocation models. Nearly every financial advisory firm offers a model investment portfolio. You can find them on their websites. It's the ideal mix of stock, bonds, and other investments blended together based on your age, risk tolerance, and investment goals. This great Forbes article provides 3 models: an income portfolio, largely in bonds, a balanced portfolio, nearly 50-50 stocks and bonds, and then a growth portfolio, which is much more into stocks than bonds. And you'll see these 3 basic categories as you do research. So what's the lesson here? Unusual investment strategies are difficult to understand, they're hard to monitor, and they may not be reliable over the long term. So consult with a financial advisor and make sure your advisor has your entire financial picture all in one place. That might include investment accounts, retirement plans, real estate, rental income, and any inherited assets. So balanced portfolios tend to work, so go out and find out more. And you can find more great content on accounting and finance at accountingaccidentally at substack.com. Thanks.